So welcome to the last session. We are devoting this session to ongoing European policy making. So first of all, let's see if Tanya is already here.
Yes, I'm here. Hello.
Hello. So we first have Tanya, who's head of unit at the European Commission's DG ISMA, and she is responsible for the Capital Union. And she'll tell us a bit about that program, that policy program that the Commissioner already mentioned this morning at the very beginning of the conference. I think she'll also tell us and you that there is, the Commissioner already told us this morning that there's a revision that's being planned, new initiatives to complete this, as he called it, flagship project, which now in COVID times has become even more important. And I think Tanya will also tell us a little bit, as much as she can at this point, about what the plans are. Now, as input to this, the Commission had put out a call for tender for a study to inform its thinking about what has been achieved already in the Capital Market Union or not. And the contract was awarded to Auxera, an economic consultancy. And we have Jonathan Hayes today with us, who is going to present some initial findings from that study that Auxera has conducted for the European Commission. So without much further ado, Tanya, over to you, and then to Jonathan.
Thank you, Marco. Good afternoon, everyone. I'm there in Riga. I will perhaps start with a bit of preface, if you don't mind, before jumping into the policy measures and actions or measures that we're taking to address the problems. So I haven't participated in your morning session. Probably you have addressed a lot of what I'm going to be saying, but I thought that kind of introduction or background would be important to then transfer to the topic of policy measures, so policy solutions to the problems identified. So let me start perhaps with a banal statement. Capital markets are important for developed economies. They are even more important for a union of those economies that share a common currency. What we've seen today with COVID, the role that capital markets can play, they're seen as an important transmission channel. You cannot just support companies with fiscal measures, with public support, public subsidies, without there being an important facilitator, an important supplementary channel of private market-based financing, because this support is by definition short-lived. It cannot be long-lived. Therefore, it can only stimulate ultimately the ability of companies and willingness of those companies to seek private financing. So capital markets are extremely good to spread risks, avoid concentration risks, of course, and those drastic consequences that we've seen with the financial crisis, where the risks have been concentrated largely in the banking system. So any developed economy needs both banks, as it does need capital markets. The two have to go hand in hand for the financing system to be balanced. Now, when we consider companies and what companies specifically need, I think they need both debt and equity, if not the other way around. And family money, and I know today you're talking about SMEs, but also about family companies specifically. So family money and that of your friends and relatives do have a limit. So companies need to be able to go out there and seek market-based financing, be it through private equity or public equity. And the the beauty of equity, and I'm sure you've talked about it before today, is that it doesn't have a due date. It doesn't have an interest to be paid every year. So it does offer the necessary flexibility to companies that require financing in order to grow. Of course, that doesn't mean that companies always need equity. So for certain liquidity, short-term liquidity issues or working capital related needs, the companies might be just fine with a bank overdraft. However, if money is necessary, funding is necessary to grow, to scale up, to develop, that kind of funding often is not seen as appropriate. In particular for companies with an innovative business model, with a business model where you don't have a lot of fixed assets, a lot of collateral. You have lots of good ideas, but you don't have collateral. Typically, you would not see banks being that forthcoming to grant loans. So now the question to you is, or the question that we had actually quite a lot as policymakers, are capital markets really fit for companies? Do all companies need capital markets to the same extent? Some people go even further and suggest that capital markets are only good for large firms. Those firms that need to raise hundreds of millions of euros. And they're not really good or fit for SMEs. Why so? Primarily due to cost, because of course there is cost of accessing market-based financing, in particular public equity. There's also quite a bit of cost, and that probably would go would come very close to what we're doing in the Commission. So for some of them, the cost of compliance, regulatory compliance, when you're publicly listed, is simply too high. Of course, every company needs to follow the same process. You need to go, through you need to prepare a prospectus. You need to do your due diligence. You need to pay a bunch of consultants, lawyers to structure the deal. You need to get a good investment bank, preferably a cheap one, or even a syndication of banks if you're going for a larger deal, larger issues to underwrite an issue. And then you get on a roadshow to seek investors. That does cost a lot of money that many SMEs simply don't have. So if you add to this the myriad of requirements, legal requirements on transparency, on insider trading, market abuse, as we call it in the EU, it really becomes quite expansive. So is it really a problem that it's just not worth for some SMEs to go out there and seek public equity? I would say yes or no. Yes, because less companies publicly listed means that there is less visibility for those companies that are not publicly listed or unlisted companies to investors. In particular, if you're talking about cross-border investors. Because it is a problem because there is no price discovery for those companies. That affects the richness of public pricing data. Furthermore, with less SMEs being listed, there are also less specialized SME intermediaries, like the ones that deal specifically with SME stock, like SME brokers, or the ones that specifically provide SME research, like SME research providers or SME rating companies. In a way, all of this adds up in some sort of perpetuous self-fulfilling prophecy, almost like a vicious circle of its own. The fact that there are very few publicly listed SMEs, triggering the fact that there are very few SME-oriented intermediaries, would lead to even fewer SMEs ultimately being listed, just because the ecosystem or the infrastructure around it is not there. So I said, is it a problem, yes or no? So this is the yes part. The no part. So it might also not be a problem. Why not? Because luckily there are alternatives, such as crowdfunding, such as business angels, venture capital, private equity. So in the end, is it a problem? Yes or no? I would argue today that it is a problem. And that's why in the Commission, we are paying particular attention to funding or access to funding by SMEs, and even more attention to public listing by SMEs. Why? Because SMEs do need a choice, like any company. They need to be able to get an overdraft when they need it. They need to be able to get access to private or public equity. They need to be able to actually make their own decision and be in control of their own decision whether to dilute ownership or not. Private equity typically comes with a private investor control. So usually it implies also that most of the control is being handed over to private equity investor. In the case of public listing, I think that can be structured differently. You can also issue shares that do not have voting rights attached to them. You can actually raise funding without necessarily diluting your ownership structure. So this type of investment is actually very good for long term. So what we need in Europe really is funding for every need, for every type of company, big or small. And this is where we have a problem in the EU. European businesses need access to financing at all stages of their development. Starting with bank lending and smoothly transitioning towards venture, business angels, private equity, public markets. In particular, if you compare our markets to the other markets in more developed market-based economies, we see that our markets across the board are underdeveloped. So venture capital, private equity, stock market capitalization is still too low in Europe. And as I said before, we seem to have a particular issue with public equity. So generally, if you look at the last few years, the number of IPOs has plummeted. Of course, it plummeted for a number of reasons, not just for structural reasons that we're talking about today, but also for reasons related to geopolitical issues such as Brexit, instability, the fact that London is often seen or has been seen as the main issuance place for many companies in Europe, even non-British companies. And to that end, the growth market of the London Stock Exchange is very well known. There is a general issue with IPOs, but there is a particular one with respect to SMEs. And the issues or the reasons rather for that are manifold. So I have already mentioned the cost of issuance and cost of regulatory compliance. There's also the issue of insufficient investor demand, partly due to the lack of accessible SME data, research ratings. So all of this, what can we do actually as policymakers? So this morning you've heard from the Executive Vice President that we are revamping our policy. We're looking at the Capital Markets Union project with a fresh pair of eyes. We have done it slightly differently this time. So instead of going for a very big public consultation like we did the first time around for the 2015 action plan. So action plan is, for those of you less familiar with our terminology, is basically our white paper or a plan, a program for the Commission to basically inform the public of what is upcoming in order to deliver on a particular policy objective. So what we've done this time was slightly different. We, instead of going very broad, we decided to go very deep. So we decided to put together a group of very high caliber experts on the high level forum, so consisting of CEOs, CFOs, chairs of the boards of many financial European companies, asking them one simple question: what do we need to do in Europe in order to make progress with the CMU? Not even complete the CMU, but make progress with the CMU. So what they've done over the course of seven months, involving a lot of discussions, the Commission has been participating in all these discussions in the role of rapporteurs, as we call it, or secretariat. The forum was of course an independent forum, so they exchanged their ideas freely, and we were simply listening to the ideas. And some of the ideas were actually quite bold, quite ambitious. Some of the things that we're proposing were going exactly in the direction of how do we make capital markets more accessible to smaller companies? How do we reach out to, how do we ensure that capital markets reach local, I don't like this word, but sometimes it is used, peripheral economies? Those economies that perhaps have a slightly less developed market-based financing structure, and perhaps slightly less developed infrastructure that comes with it. So what did the forum propose among the ideas? And as I would have loved to share with you exactly what the Commission would do in this respect, perhaps it would be too early for me to tell you that, because we are still in reflection following the recommendations that the forum has tabled, which we are analyzing now, and will be working on an action plan or program for us to put in place in September. And that program will accompany our work on the CMU, on the Capital Markets Union, over the next 4 years. So what exactly did the forum say with respect to SMEs and ways to facilitate access to capital, in particular private equity pricing? So first of all, they suggested that the regulatory framework was not quite fit for smaller companies. The requirements in some legislation, for those of you more familiar with the legal jargon, so MiFID, the Markets in Financial Instrument legislation that deals with rules regulating how exchanges are functioning, so organizational requirements, how investors need to be protected, rules that pertain to transparency, rules pertaining to reporting requirements for investment firms and things like that. So these rules are not necessarily fit for smaller issuers. Same goes for market abuse rules, and same goes for the prospectus rules. The latter was quite interesting because the Commission has fairly recently reviewed the prospectus regulation and put in place the so-called growth prospectus that was supposed to be an alleviated prospectus for smaller issuers. So what the forum believed was that that setting was still not good enough for smaller companies, to incentivize smaller companies to go public and list, and that the cost of issuance or public listing would still be not commensurate to the benefits of public listing. So these are all very interesting suggestions that we are at the moment looking into. Amongst those was a suggestion which is being discussed a lot, and I have my personal views, which I might share with you. This suggestion goes in the direction of removing the so-called unbundling requirement for SME research. So for those of you who are familiar with the financial rules, a few years back, MiFID II, the amended legislation came into force, and that legislation was supposed to tackle the conflict of interests among intermediaries where you had execution costs typically bundled with research costs in a way that the clients didn't even know, what they were paying for ultimately, and were receiving as a result a lot of research they potentially didn't need. So the issue was there, the issue of conflict of interest. But what the forum suggested was that the way the financial regulation was amended, and that way was basically, a straight jacket type of approach, where the unbundling requirement, whereby brokers would now have to report separately to clients, what they're charging for commissions, trading commissions, and separately what they're charging for research. Or assume those costs, basically absorb those costs and not pass them on to clients. So apparently that didn't work for SMEs for one simple reason, that there is simply not enough interest to produce SME research. And SME research actually needs to be subsidized and supported through other means, and in this specific case it would have been cross-subsidized by the commission payments. So as the forum participants alleged, that did lead to a situation where without this cross-subsidization, the research simply dried out. Now, there might be something to it. It is clear that MiFID II did not contribute to more SME research being available. On the other hand, there is also abundant evidence that suggests that SME research was already non-existent pretty much even before, long before MiFID II started to apply. There were also a number of other recommendations, other suggestions supporting SMEs. One of those suggestions was to establish a single point of entry for company data, with a possibility for SMEs to opt in this regime. So that would provide basically a repository of company data, which would be accessible to all investors across the EU. And this measure might facilitate the visibility of companies, but in particular SMEs, because SMEs are struggling, of course, much more than other companies because of the lack of the data and research. And therefore, this tool might enable investors to have a much better access to company data. There is, of course, the need to support the investor base. As I've been saying before, there is a problem of insufficient investor demand. So how can it be done? The forum actually picked up on the idea that the Commission has already announced and has been working on, which goes around building public-private structures to serve as anchor investors for SMEs, for SME investment, in a way that the public money would crowd in private money and then be invested in funds which invest primarily in SMEs. So that would provide and drive, if you wish, the investor demand for SME equity. Of course, what is important when we use public money is to ensure that the policy objective is being achieved, and that there is an underlying market failure. So I think there is abundant evidence indeed that suggests that there is underlying market failure, which public money therefore is trying to remedy. So HLF recommendations now on the table, us looking at them very, very carefully. Lots of recommendations, I think 17 bundles of recommendations, not 17 recommendations, but 17 clusters or bundles of recommendations, amongst which also a lot to support companies and specifically SMEs access to funding. Now, HLF has been one element of how the Commission is seeking input on its new work program or new action plan on the Capital Markets Union. We have been, and Marco, you did mention, we are also commissioning studies. One such study has indeed involved ECGI, and Jonathan will speak after me and will share with you preliminary findings of that study. The study that specifically looks into the role of public equity and specifically looks into primary issues and secondary trading and tries to analyze problems with those markets. So this is where we stand. So at this point, it would be difficult for me to provide more insights into what the Commission action plan to be adopted in September will include. We will go, of course, through the political vetting. So the Executive Vice President, whom you have had the pleasure of meeting this morning, would have the privilege of driving that decision-making process, even though, of course, the final plan would have to be subject to a college decision. So the decision of all 27 commissioners and the president, of course. With this, I think I've exhausted and actually spoke more than I wanted to speak. With this, I'm passing the floor to Jonathan, who will explain basically what ECGI has been doing for the last many months, and share with you the preliminary findings of this study. Thank you very much.
Thank you very much, Tanya. I think you've set out the background in terms of the policy thinking and also the way the different initiatives and thinking fit together and what to expect. I think you've set that out extremely well. I think I expect we'll have a discussion afterwards, because certainly this morning we heard at least two voices claiming skepticism that families are not thinking carefully enough before actually venturing to go public. And certainly today they're being challenged from one side, shareholder activists, and on the other side, ESG and sustainability considerations in public markets. So the challenges are really out there for companies that want to list. So I think we're going to have more of a discussion once Jonathan has done his presentation. So Jonathan, over to you, and we are looking forward to hearing what you found so far.
Thank you very much, Marco, Tanya. Can you hear me? Fine.
Yeah, we can hear you very well.
Perfect.
And we can see your slides. Great, thank you.
Okay. Sorry, I'm just trying to work the technology. Yeah, so thank you very much, ECGI and Stockholm School of Economics, Annette, for inviting me. Thanks, Tanya, for those introductions. I'm going to provide a brief overview of the study. Tanya's done a bit of that already, and then, as Tanya said, some initial findings on three topics of the study. What we found so far on three topics I thought were relevant to the theme and the discussions that we've had today, particularly around the funding mix of European corporates, the economics of listing, and some observations around why some firms choose to remain private. And much of this is in line with what we've had this morning, which is good to hear. And then hopefully, as Marco said, there might be a bit of time for, if people have still got energy, for some Q&A afterwards. So I'll just go through very quickly on the introduction of the study. So why the study? Tanya's already highlighted the sort of process that the Commission are going through. I think from our perspective, I think we are trying to give the Commission a good evidence base. We are doing what we see as quite a comprehensive review and detailed review of the functioning of primary and secondary equity markets in the European Union. We've taken stock, we've looked back at how these markets have been performing over time, and we're also trying to help the Commission assess different possible policy options that are available and how those policy options may be appropriate depending on different development paths that may emerge in the future. So the scope of the study is pretty broad. The Commission set us quite a challenging mix of questions on the primary markets and the secondary markets side. So today I'm just going to focus on one aspect of quite a much bigger study and the questions around the sort of listing decision. We also have done some thinking about the drivers of listing location. We've also been looking at particularly a bit more detail on the IPO process, and then a number of questions on the secondary market side, some empirics about the explicit and implicit costs of trading, but I'll leave them for another time. So in terms of the sort of analysis, what we've done, it's primary, secondary, we're looking at 27, EU27 plus the UK, so 28 as well, across time over financial centres, and then mixture of different analytical techniques. Been interested in the impact of technology, how technology is changing market dynamics, and then the big question about what would happen when the UK is not part of the capital markets in Europe, or how that role would affect things. And then, a big caveat that this is work in progress, still in discussion with the Commission. So I think today I'm focusing on some factual observations based on the empirical analysis and some of our survey results. So in that line, our analysis has sort of been based on a lot of quantitative data, both primary data. We've done quite a big data collection exercise across all the European exchanges, supplemented by the sort of existing data sources, such as on the listing side, Dealogic, World Federation of Exchange data, etc. We've had interviews with around just 250 to 300 people, so quite a lot of market practitioners we've spoken to across Europe. We launched a survey to issuers, and then an extensive literature review with academics. So we've got, I was going to say, this is a big team effort. A lot of people behind this in Auxera. And also, those are people who know Auxera well. We work very closely with our academics. This primary market analysis has been driven a lot by Professor Tim Jenkinson, Professor Julian Franks, and also Marco as well, help steer our primary market thinking, as well as other familiar faces you will probably know from the ECGI family. So that's the background on the study more broadly, and now just some charts to give a bit of context on what we found from the data on the funding mix side of European corporates. So first of all, public equity markets in Europe are much lower than the US. This is well known now, despite the similar size economy. Total, so that's the sort of the chart on the right hand side, which I think people are quite well aware of now, which helps to motivate why Europe is trying to develop the size of its public equity markets as an alternative, as Tanya was talking about, as an alternative funding source for corporates in general. On the left hand side, it's important to remember that on the equity financing side overall, I think Europe is doing okay, but there is that sort of big dark blue line. There's quite a lot of unlisted shares, a lot of funding that's happening in private equity markets within that. There's lots of different things going on, but it's important to sort of remember that initial context. And then when we think about the question about the attractiveness of public equity markets, that is a function of, as some of the other previous presentations were referring to, is a function of the attractiveness of alternative ways to raise funds. If you're a owner of a company and you've got some NPV positive cash investments projects that you want to finance, there's different ways you can do that. And a key point of that will be the cost of funding. What we've seen is that the cost of listed equity, has remained relatively high in recent years. This is just data from the ECB 2015 to 2018. Meanwhile, the cost of borrowing for firms has declined to quite low levels, which makes debt-based financing more attractive. And although it's hard to exactly quantify, the incentives for companies to list and raise funds have significantly reduced in this changed environment. And here's a chart that shows the sort of value of investment and fundraising made by European offices on the private equity side. Another observation which we've heard from others is that many large institutional investors are increasingly seeing greater equity ownership, wanting to take direct equity ownership and financing private companies due to greater control, which we've talked about as well. So you've got that mixture. Sorry, you've got that mixture of cheap debt finance and sort of a growth and a sort of the development of the private equity markets in Europe. I have to say we have less visibility on the geographical distribution of private equity uptake. I'm aware that in some countries these markets have been thriving much more than others, so the dynamic is very different in different countries. Which brings me to the sort of next slide. When we drill down and look at the funding of corporates across member states, we see some different nuances across different countries, which is also helpful because that helps us draw lessons and evidence for thinking about what may be the right policy mix to take. And here we look at this chart, for example. I think we see some different groups emerging here. We've got those that with relatively well-developed public equity markets relative to the size of their economy, but also have well-developed private pension and insurance systems such as Denmark, Netherlands, Sweden, etc. You've got those newer member states where capital markets have developed more recently. This was the point that's just been made, which I think is very important, where, you know, such as in the Baltics, where there hasn't been a long time since these countries have had capital markets. They're starting from a different place. So it's very important from a policy perspective to kind of recognize that when thinking about appropriate policy measures. Then you've got those where the households typically relied on state for their pensions, France, Italy, Portugal, Spain, and those where the corporate sector have traditionally been more bank-based, such as Germany. So sort of the big policy question, I think, for us to think about and for the Commission to think about is what's the best approach to market-based finance, or what policy measures in the round can they put forward to develop market-based finance, and as Tanya talking about how to develop public equity markets. Sort of spoiler alert on Auxeria's side, I think Auxeria's view, perhaps unsurprising, is we think that you should both embrace private markets and public markets, and sort of the development of some of the private markets is being quite a good thing, and also you want to ensure that you can foster a good public equity market at the same time. So next, I'd like to provide some observations on the economics of listing and fundraising in markets. So we've been speaking to quite a number of market participants and issuers, including SMEs and family-controlled companies, around the costs and benefits of listing. Ultimately, the decision to list depends on the net benefits of the firm going public versus the negative impacts. There's been quite a really good discussion about this already today. Our feedback we hear from issuers indicates that the initial and ongoing costs of going public have risen and widened the gap between public and private companies. The top benefits to listing identified analysis are the exit route for existing shareholders, the acquisition point that's already been made, where listed shares makes it easier for people to buy other firms. And also we did hear about the access to additional equity. If a corporation wants to fund of a significant size of volume, it still does need to go to the public equity markets. If it's trying to raise a small amount of funds, it could go in the private markets, and that amount of funds I think has been growing that you can get access to in the private markets. But if they want to scale up to a very large degree, I think at some point they do need to go to the public markets. And the costs of listings are, you know, both the direct costs, including the fees to the various different parties that Tanya was referring to, all the advisors, lawyers, the investment banks, the exchanges, etc., and indirect. And I think the indirect costs are very, very important here. The agency costs, and we've had good discussion around some of the aspects there, underpricing, and some of the important points increasingly around the risk to companies of disclosing certain information, whether that be for potential litigation risk, which I think has been a big issue in the US, less so in Europe, but there are people who are in Europe who are worried about that. Or potentially in the future, whether it's about ESG type risks, if you're worried that you're going to expose your company to public backlash, etc. That's something we have heard as well. So our analysis, as I said, we've spent a lot of hours, a lot of effort looking at our data set on primary markets. When we spoke to the exchanges about data on listings, they told us that the existing databases have their flaws. So what we went for was a sort of bottom-up approach of asking all the different exchanges for all their data on listings, and then collecting that together in a sort of big panel to look at the stocks and flows of listings. Where there are gaps, we've supplemented that with sources like Dealogic, World Federation Exchange data, etc. But most of our data is sort of directly from the exchanges, where we're looking at the stocks and flows of stocks and flows of listings, to try to understand really what has been driving this sort of phenomenon of an overall reduction in the number of listings. I think here I've just put some charts to give an illustration. So on the left hand side, we've got the sort of overall figures between 2010 and 2018. We strip out all sort of financial vehicles, investment vehicles, etc. So we're focusing only on real economy firms, and we have seen a sort of gradual decline in listings because, as has already been pointed out in previous presentations, the number of inflows of IPOs has not outweighed the number of outflows through delistings, mergers, or company failures. On the right-hand side, you do see variation across Europe. Sweden's already been pointed to as a good example. We agree with that. That's something we've heard, and we've been looking at the examples in Sweden. On the bottom right-hand side is a waterfall chart of the inflows and outflows on the First North Stockholm listing market, the junior market in Stockholm, where you can see that the listings have increased relative to the more inflows than outflows. Whereas on the AIM market in London, there has been quite a big reduction in the number of companies seeking to list. Well, the inflows relative to the outflows. And what we found overall across Europe, looking at all the different markets, is that M&A activity, as well as the development of private equity markets, are two key driving forces that are driving the decline in listings. Here's another chart that presents the number of IPOs on EU 28 exchanges between the year 2000 and the year 2019. The height of the boxes and the width of the flows are proportionate to the scale, the number of IPOs. And this data is from Dealogic. And we can see here that most companies, this perhaps unsurprising, there's quite a very strong home bias in listings. I think at first glance, you might think this is an issue for CMU, but what we've also observed is market integration has led to greater connectivity on the investor side, at least for large institutional investors. I think that's an important point that was made before about the differences with the retail investor side. But what we have seen, the data tells us that there's still quite a lot of home bias on the listing side, but while historically a company may have sought to list in multiple jurisdictions, to dual list, multiple listings to access different pools of capital, we see that the benefit of that has reduced significantly thanks to market integration. The likes of the BlackRocks, etc., are able to access capital in multiple markets. So the market integration in Europe in particular has meant that international investors are able to access those pools of capital. Having said that, there are still challenges for smaller companies and for smaller financial centers, which is what Tanya was referring to. Then, as we are in Riga today, or we'd like to be in Riga today, I thought I'd give some a bit more local, some local observations, which also fantastically, I didn't know that Vice President Dombrovskis was going to refer to the Port of Tallinn, but fits in quite well with what we've got here. So here is just our data on the exchanges in the Baltics region. We can see, as was pointed out before, that there has been that decline in the overall number of listings is also been occurring, at least on the main markets in the Baltics. In 2018, the number of listed companies in Riga was 15 on the main Nasdaq index, 3 on the First North in Riga, which is the junior market. In Tallinn, there were 13 on the main Nasdaq market, none on the First North Tallinn. In Vilnius, we had 22 on the main market and 3 on the First North Vilnius. So there are 3 key observations from me on this. One was that this declining trend in listings is also appears to be happening in the Baltics. 2, very importantly, the Baltics are very small by European standards. So if we compare these numbers to some of the other markets, so the LSE in 2018 had 1,439 listings. Nasdaq Stockholm had 555. So much larger markets, which we need to think about these markets in very different ways. And the trading is concentrated in a relatively small number of anchor stocks. So below is a chart on the distribution of trading activity of the top 5 stocks in London Stock Exchange compared to the Nasdaq Baltics. So in Nasdaq Baltic, got the top 5 largest stocks are taking up 64% of the trading value. So the large stocks are very important in determining the amount of trading activity, and I think this links to this point around which we've heard, and the EBRD have been doing quite a bit of work on this, and I think the Commissioner also thinking about this around the role of anchor stocks and anchor investors. So the Port of Tallinn is an interesting case study in the Baltics region. The Port of Tallinn is the 4th largest port operator in Northern Europe. Successful IPO in 2018 that was triggered by the government wanting to sell a minority stake. This was, largest IPO in Estonia for over 12 years and raised a decent amount of money for the government. Highly subscribed, importantly also by retail investors. But what helped this was that the EBRD took a stake in it, and we heard that helped kind of reinsure investors that there was an anchor investor in that stock. So both on the sort of the decision by the government to attract international investor interest in an attractive company from an investment point of view, along with an investor such as the EBRD to provide some reinsurance to those investors. That kind of measure, I think, has helped to attract more interest in the Nasdaq Baltic ecosystem when policymakers are thinking about how to develop these newer local markets. Thought it was an interesting case study. So next, some observations around why firms choose to remain private. So I think to this audience, these points probably be fairly obvious, but there are important question is why and we have identified quite a large number of firms who are quite large in size and remain unlisted, but they could be listed and they meet the sort of typical criteria to be listed. So the key question is, why aren't these firms choosing to be listed? And many of these firms are family controlled enterprises. So a lot of the points that we'll be discussing today are relevant. And we have identified 5 key themes, key challenges. Firstly, the point around disclosure of information, which I've already mentioned. Second, unfavorable listing environment, which I mentioned as well, the relative pricing of other ways to raise to finance your positive NPV projects. 2 really important points, I think, for family controlled enterprises that we have observed, which mirrors, what has been said already around control, existing owners not wanting to cede control to new investors, and agency costs. Agency costs in terms of owners it being harder for owners to ensure that the managers of their company are acting in their interests. I think we've heard that is a tricky thing. And then also short-termism, concerns by family-run owners around whether, I think there might be a feeling that the investor, that some of the typical characteristics of investors in public markets have different time horizons or visions to some of the investor characteristics you get in private markets. So I think we have heard concerns that if you are going to list your company, then there's a risk that the time horizon for your business objectives will be different for these new investors that you are bringing on board on your company. Then on the SMEs in particular, SMEs face particular challenges. I think this supports what Tanya had been saying already. So feedback from market participants has indicated over the last decade it's become more challenging, more costly to list, and particularly for mid-sized corporates to seek funding from public markets. The fixed costs of listing are much more important for smaller companies because, sort of by basic maths, of the issuance size. So it becomes much more relevant. Things like the regulatory costs that Tanya was talking about, things like the underwriting fees. We've heard quite broadly across Europe, for smaller companies, the cost of listing has risen, and for larger companies, for companies with that want to issue larger sizes, maybe they can absorb that. For smaller companies, it has become much more challenging. Another element to this is liquidity. The costs of trading on SME stocks are typically higher, which you would naturally expect, but we do see quite a big difference. Here in the middle, we've got some data which we bought from Virtue. So we've done a lot more analysis in our study on cost of trading, implicit and explicit costs. Here's just a flavour of the difference in average bid-ask spreads in the first quarter of 2019 for companies that are 200 million to 500 million in size compared to those that are greater than 5 billion in size. And you see that the spreads, the average bid-ask spreads on the companies of 200 to 500 million in size is significantly higher than those greater than 5 billion. People have talked already about some of the important aspects of this. I'd say the impact of, I fully agree with the points that have been made already about the impact on passive investment. We've been thinking a lot about this internally in Auxera with our academics around the role of passive investment and what passive investment will do and has done, and the role of indexation and those types of things. It's another important policy consideration to think about when we think about the future of equity markets and what we may expect in the future structure of equity markets in Europe. And then a third point is around incentives to the advisory system. So there's a big network of advisors that are important to help promote and facilitate the ecosystem for listing of SMEs. And in a region such as Baltics or a market such as Riga's, where SMEs are is much more important. This is particularly important point here. What we've seen from a sort of evidence perspective is a fall in the number of advisors, and also slightly more qualitatively, it's harder to get quantitative evidence on this, but we've heard that the incentives in the advisory ecosystem are much more it's more attractive to be the person that's working on the big deal for the larger stocks than it is for the smaller stocks. So the economics of advising on smaller listings is not quite the same as the economics of advising on larger listings. Then another important point, which has already been discussed, so I won't go into it too much detail, is the conversation around the research coverage. And when you're trying to buy SME stocks, information asymmetries are quite high. There's I think the role of research and visibility of these potential investments is very important. There's been conversations around the role of MiFID, but there's also a broader issue about how to promote research coverage on SMEs. So yeah, so what does this mean for policy? Well, our analysis is still ongoing. We're still working on policy recommendations with the Commission. At a high level, some of the key themes to think about, and I think Tanya's already touched on some of this: issue of costs in an efficient market. Issuers should be able to raise funds at low costs. Can they do that? Investor appetite. How do you get people interested in shares, both institutional side and retail investor side? The role of intermediaries in the advisory ecosystem, I've just touched upon. Fund structures, what are the role for different fund structures, both in terms of the diversification benefits from a risk perspective, but also when you're thinking about those challenges around short-termism, long-termism, etc. And particularly given the challenges that we were in the UK, there's been focus on the Woodford debate around liquidity and needing to make sure that investors have clear objectives, making sure that the expectations on liquidity are aligned is very important. And then governance, how best to manage issues around separation of ownership control and what can be done to help encourage family-owned companies to get over those hurdles. I think at that point I will stop in case anyone has questions.
Thank you, Jonathan. Do I see any raised hands in the chat? Any questions to Jonathan or to Tanya Panova? So let me then ask Jonathan, out of these factors that you identified that prevent people from going public, do you have any sense or measure of which is the most important impediment? Oh. Let's see if we can unmute you.
Hi, sorry, Mark, are you referring to these 5 factors? Or were you meaning on the last slide?
No, to the slide you had about the 5 factors that you've identified from preventing people from going public.
Yeah, so I think we think that agency costs is quite an important factor here. Clearly, I think in the US, information disclosure is a really big issue, and it may become a larger issue in terms of that balance between private and public markets. I think the direction of travel is definitely the more information disclosure is making it more challenging. I think those 2 that I've got highlighted there are the 2 that we think are particularly important. Considerations around control and agency costs, and the conversations that previous presentations have had around whether it's possible to allow more flexibility to allow investors to price in control in their choice in stocks, to allow more flexibility, to encourage family-run companies to list. I think there are successful examples of that. So we know that Asia, US are attracting a lot of stocks by relaxing some of those rules, and we have seen some success in some parts of Europe from that perspective as well. I think, as Tanya was signaling, I think, also thinking about the fixed costs for when we think about SMEs, I think thinking about the fixed costs, and the Commission have done all these great initiatives around trying to promote SME growth markets. I think that will be important for SMEs as well.
Now, institutional investors, if you talk to them, they're usually not in favor of relaxing any rules. In fact, they want, if anything, many of them want stricter standards. For example, on control enhancing mechanisms and these kind of things. So there seems to be a bit of a contradiction. How do you reconcile this?
Yeah, so
I mean, let's think about Mark's paper today. I mean, the earnings manipulation even by family firms. So
think my answer to that is when we spoke to the guys that are pricing assets, if you're good at doing your models, you can price in those aspects as part of your when you price the stock. But of course, you're right. I think, you know, as you know, Marco, we're thinking hard about that with our academics about getting the incentives and the market design aspects right, and making sure that the controls in place. You need to come up with measures. Ultimately, efficient primary markets are about making it easier for buyers and sellers of assets, of people wanting to issue to meet with investors. And you know, part of that is about the disclosure information, so it's easier for the investors to price the assets, and part of it is making sure the issuer is happy to give up a sufficient amount of control, and the investor side they're willing to give a certain amount of money for that amount of control. So I think, you know, my own reflection on that is there are ways to design the market such that you can efficiently price that in from an institutional investor side. However, you know, you also do need to have the safeguards in place that allow the investors to exert discipline as well.
Now, maybe Tanya, a question to you, and please raise your hand or type questions into the chat so I don't monopolize the questions here. Now, could you just explain to those who are not familiar with the everyday workings of the European Commission and its powers, what kind of things European rules can actually change and what you cannot change? So presumably, for example, if there are any obstacles to the single market for capital here, then you have a direct mandate to remove those obstacles. In fact, you have a duty-bound mission to do this. Now, beyond this, it gets more complicated. Could you just outline what kind of things, and you don't have to say which ones you're going to tackle, but just to give examples, which of the kind of things that Jonathan has listed you could actually tackle if you decided fairly easily, and which other ones are really more difficult because they're political or they're outside the mandate of the Commission, or they need the consent of the Parliament and the member states on these sort of things.
Thank you very much, Marco, for the question. A very good one. I think everything that has to do with financial legislation, financial acquis, as we call it, is doable, is within our reach. What it means in practice, let's say rules pertaining to listing. So what supervises, what regulators require companies to do when they seek listing. So for example, whether or not a company seeking listing would need to produce a document that needs to be pre-authorized by supervisors, which today exists, of course, and it's called prospectus, for certain amounts. So below a certain amount, below a certain threshold, you don't have to do it if you don't offer your securities in other member states. So if you don't want to benefit from the so-called passport, securities passport that prospectus provides you with, then below a certain threshold you don't need to have it. But above that, and if you want to reach cross-border investors, so provide offering or trade on venues outside your home member state, you need to produce this document, which needs to be done in a certain way. Contains certain type of information, which is actually spelled out in legislation, be it primary legislation or secondary. So the way we do legislation, we propose rules, then the Parliament and member states agree on those rules, but a lot is left for secondary legislation. Primary legislation includes a lot of mandates, then for the Commission to adopt those measures. The way we do it, we usually seek advice from European supervisory authorities like ESMA or IOPA in Frankfurt or EBA, banking supervision. So all of those things that really pertain to documents you need to comply, authorizations you need to seek, let's say information you need to publish, such as information pertaining to so information that would have a fact, which could therefore be seen as inside information, because if you come in the possession of this information, it might, if you were to act on the basis of this information, you might actually gain considerably from that, and that information therefore needs to be disclosed to the public. So those rules, how this information needs to be disclosed, how frequently, at which point in time, this is all stipulated in EU financial rules. So this can be in principle modified. So you can introduce certain alleviations, you can introduce certain proportionality features that already exist, and we were trying to introduce more of those. So Jonathan did mention growth markets. So we try to introduce, let's say, a more alleviated legislative setting for trading venues that typically have SMEs listed on them with smaller capitalization. And those rules, because we want to promote those types of venues, which specifically attract SMEs, we put them under a less strict legislative setting. So those types of requirements are fine. Now, when we get into national laws, or when we get into tax, then this is when it becomes slightly more complicated. So when it comes to national laws, I don't think that, Jonathan, you mentioned anything on that. But for example, a long-standing debate on CMU, it is relevant for all kinds of companies, not specific to SMEs. Let's say specific to all companies when you have cross-border investment, and more relevant for debt instruments, less relevant for equity, even though of course you have some spillover effects on the cost of funding. But for example, very divergent insolvency rules. So the rules that actually determine what are the outcomes of insolvency procedures, how much of your value you can recuperate as a result, what is your priority in the list of creditors, how quickly you will get your reinvestment, what are the costs associated with you recovering value. All of these things, of course, are determined in national laws, national insolvency laws. The Commission, in principle, has a possibility to harmonize those laws, but as you all know, the Commission has the power to initiate. We don't have power to co-legislate or legislate. For that, we have our two co-legislators, the Council and the Parliament, who have to agree to our proposal. So in the past, it's been extremely difficult to harmonize laws, even though there is no problem with the legal basis. But there was really a problem, a more of a political problem for the member states, and Parliament was fairly open to that. But the member states found it extremely difficult to agree on measures that would align insolvency rules. And of course, if you don't align insolvency rules, what you have as a result is, first of all, a huge diversity across rules, which affects the legal certainty of cross-border investment. So it actually dissuades investors from going cross-border, because they simply are not familiar in all of those cases what that specific member state's bankruptcy laws are, and how much they will actually be able to recover, and what the court capacity is going to be, and whether it will take them 8 years or 2 years to recover the value. So all of these things actually dissuade investors from going cross-border, and that means that de facto it also limits the investor base, including for SMEs. Because those cross-border investors, which could have been, in principle, investing in those companies, decide not to do so, precisely because of the complexity, because of the diversity of national frameworks. Now, tax is yet another matter, and this is even more complicated, because with tax, we're no longer in QMV, as we call it, the Commission jargon, or the qualified majority voting. We are in unanimity. So the Commission can still propose measures, but those measures, first of all, need to address issues of discrimination in the cross-border context, as discriminatory practices. And even if it does propose certain harmonization measures, it is subject to unanimity. So we're no longer in the ordinary legislative process, as we call it, but we are in unanimity. So it's only the Council deciding. So all 27 member states have to sit down and say, we agree. And this is extremely, extremely complicated. So of course, in principle, we also on financial acquis, we try to seek consensus with the member states, and that's why it takes sometimes a lot of time, because you need to actually build consensus. But there are also some member states who realize that because it's QMV and not unanimity, they cannot basically get everything. So that also contributes to being able to find a consensus. On tax, there is no such presumption because everyone actually has to agree. And the issue of tax is particularly relevant for SMEs when you actually create instruments or vehicles that you want to incentivize investors to use, and those vehicles specifically seek to channel financing to companies, specifically to SMEs. So because SMEs, as has been said a lot before, struggle to build the adequate investor base, in principle, that does constitute a market failure, which can maybe tackled with public resources, be it European resources or national resources. So in the case of national resources, we could be potentially talking about tax alleviations, tax incentives. But this is something that every member state would have to do on its own. So to promote those vehicles and those types of investments with its own measures, because those types of actions are actually quite out of reach for us, and therefore the only thing we can do in those cases is to work together with the member states to promote best practices or agree with them on the code of conduct, or if a sufficient number of member states agree among themselves, actually work on the so-called cooperation, enforced cooperation procedure, where it's actually member states joining up forces together and agreeing upfront that they would be they would be adopting a certain legislative measure which would apply only to them, but not those other member states who do not sign up to this enhanced cooperation arrangement. So this is, in short, the complexity that we are facing in the Commission.
I think we got a sense of the easiness of the whole project, given the complexity of your answer. Now, we do have one last question, and then I think we have to wrap up. Morten already had to run to another conference that's just starting in the United States, just to see what the global business this is. So we have one last question from Imants Tisniks, who I understand you're an advisor with the Lithuanian Ministry of Finance. So let me slightly rephrase your question. I think one issue that's come up all day is, of course, Jonathan mentioned passive investing, it's indexing. It's increasingly important whether you include it in an index or not. And the whole question of who produces these indices and who gets tracked is, of course, very important, because that essentially decides whether you're being invested in or not. So I see here that and I didn't know this, the high-level group has suggested that there should be a CMU index for SMEs. Now, that might be a very good idea, but the question, of course, is who would produce such an index, and then is it going to be tracked or not? So, I mean, maybe a short, if you have any ideas on this, Tanya, as another example, is this something that you could facilitate? I understand that there's already a project like this with the EBRD, or is this something that an institution like the EBRD might be better placed to do than, the European Commission?
Thank you for the question. It's one of those questions that you hope not to get, because there is not an easy answer to that question. And actually, EBRD,
it's got to be short.
Let's see.
Maybe that will help, or it will make it more difficult. I don't know.
Right. So EBRD has actually been an observer in the HLF, so in the high-level forum. And we've discussed a lot with them this specific issue. The issue has also been brought up by the Baltic member of the group. We're well familiar with the complexity, because what we've heard is that indeed there is a lot of there's a practice of treating certain, again, I don't like this word, peripheral economies as frontier economies, and therefore they fall outside the well-established indices by the big index providers like MSCIs or stocks. And as you, Marco, correctly suggested, if you're not in a big index, basically you're not being invested in, and of course that drives, as you've probably discussed earlier today, but a lot of retail investment is now going into passive investment, and I will retain my position as to whether this trend is a positive one or a negative one. But it's a reality. So a lot of investors, retail investors, are investing passively, and of course that means that the role of indices is extremely important. Now, what the Commission can do. So in the area of benchmarks or indices, well, first of all, we have the sort of the benchmark regulation that establishes, basically regulates how indices can be provided, you know, deals with conflicts of interest, with liability, with you know, what administrators can do, what they can't do, how they can, you know, disseminate information, etc., etc. So all of this is regulated, and not every jurisdiction, by the way, have it still, but we have introduced it as part of the post-crisis reform after the 2008 financial crisis. On top of that, what the Commission can do, we can put in place labels, so-called labels, which is in a way used to be called 29th regime, but since the 1st of January became 28th regime. So the regime which is of voluntary nature, which requires providers to comply with certain rules, but then in a way offers certain reputation, certain recognition, and is therefore more likely to be taken up by investors, or by funds who decide to, asset managers who decide to use that particular index in its investment strategy, in the fund investment strategy, in order to either track or replicate basically the performance of the index. Now, we've done this with sustainable indices because there was a demand. So the industry was already developing those indices, and therefore, you know, what the Commission did with the setting, it simply tried to create some sort of, you know, index with a reputation, because there was a lot of greenwashing. That was the main concern, that some of these indices were called green, while in reality they were not. So the Commission decided to put forward this label to say, okay, this is, if you comply with those requirements, you're really green, and investors therefore recognize and respect that index for that matter, and therefore it's likely to be more frequently tracked or replicated. In the case of SME indices, the difficulty is that there is no underpinning demand. So the creation of indices is driven by demand. So if MSCI or stocks see that there is really a demand from the investor side, from the asset management side, to invest in those indices, they will produce that index. They don't see this. In the Commission, we cannot create this demand. That's the complicated part. We cannot create demand. However, I think this is what EBRD is working on. You can basically work on some sort of private-public initiatives where you get private stakeholders to get into some form of code of conduct arrangements or best practices arrangements, where they commit to certain activity involving those types of indices. And if there is indeed demand behind, even if this demand is you may argue, a bit artificial because it's driven by the policy imperative rather than market driven, so to speak. You might actually trigger or catalyze a change, and then of course then it becomes like a self-fulfilling prophecy. So the more you create that demand, the more administrators, big international administrators would start actually producing those indices and things like that. But so these are the things that are possible. Everything else is unfortunately not possible because we cannot force people to use them. You cannot force unless you link it to a particular regulatory failure. So we legislate when there is basically market failure, when there is a risk to integrity, when there is a risk to stability, when there is a risk to, let's say, greenwashing or market abuse, then this is when the Commission regulates. Otherwise, it's difficult for us to use our tools, which are legislative tools, even though we also have non-legislative soft law, as we say, recommendations. But those recommendations will just, first of all, it's difficult to know to whom they should be addressed. Usually they're addressed to the member states, of course. How do we drive that change in the market? I think it requires really a lot of also private-public will, private will as well to support the development and emergence of those indices.
Sure. So you can facilitate the production, but of course you can't force the adoption. So Jonathan, you want to say something short because I just had a signal from Riga that I really have to start wrapping up. So.
I was just going to say, as someone from the Ministry of Finance, what we've Auxero we've seen is the best way to create demand is tax incentives, and there are some good examples particularly in Sweden, Italy, and the UK, where well-designed tax incentives can help fix that chicken egg problem. And the other point I think I was trying to make in my presentation was around the role of anchor stocks and anchor investors. So anchor stocks in terms of creating demand, so you attract investments that people really want to invest in, and then that kind of helps with the culture on the chicken egg problem. And the same anchor investor is what the EBRD are doing and the Commission are thinking of doing.
Great. So I think this is the beginning of a discussion we are going to continue after the summer, when we hear what the new proposals are, and there's certainly a lot to be discussed. So let me start and try to briefly wrap up before we thank everybody and so forth. So I think we start this morning with, of course, a statement from Vice President Dombrovskis about the general policy setting and just how important the Capital Market Union is. And in particular, he reminded us also how important the topic we have today, SMEs and family firms, are for the European economy. And if in doubt, I think COVID was a natural experiment to just prove the point, because part of the decline, of course, in economic activity is due to the fact that family firms and SMEs have been hit so hard. We then heard a very comprehensive overview from Morten Bennetson about family firms, and I think one of the striking things that he mentioned was that just the very definition of what is a family firm. And I think he highlighted that just control structures and so forth are not enough, because we wouldn't call a founder-controlled firm, for example, a family firm. And there's more to them. It's about culture and so forth. And I think that then also led into the afternoon with Vicker's paper, reminding us that family firms can even be family firms when you don't have a controlling owner, but the family, for some reason, whether it's the nominations process or culture, actually has a permanent sway over the firm and manages to stay there, has some staying power. We also heard about challenges on the one hand, and I think, Jonathan, you mentioned this again in the last presentation. You have challenges from the market for corporate control, which today no longer takes the form of hostile takeovers, but of shareholder activists. Now, Morten gave negative examples. You can, of course, have a different view of Cadbury. You can say that Cadbury had maybe lost its way and it needed to be shaken up. So I think there is, of course, a debate going on. And we have the other side of it, which Jonathan also highlighted, that family firms today are, of course, being challenged like everybody else on their sustainability record, and whether they want, many of them certainly want to be leaders, but it is a challenge for them like everybody else. We then heard in the afternoon that compelling evidence from this experiment, from this tax experiment, that actually owners do respond and that they have influence over the firms that they control. So if you exert cash flow pressure on them, they will pass that on to the firms that they control. I thought that was very compelling evidence. And then we, of course, heard, as I said, about the Japanese firms. And lastly, Mark gave us some evidence that earnings manipulation is not just a concern in widely held firms, but equally in family held firms, reminding us that the tension between families and the institutional investors whose investments are being sought are there, and that in fact the kind of regulation that protects minorities is very important. And then I think I don't have to really wrap up on the last panel. I think we had a very good and extensive discussion about some of the challenges we have moving forward and the policy challenges lying ahead of family firms, and tying them into the capital market union. And of course, we haven't discussed private equity that you mentioned, Jonathan, and I think that's something that we need to discuss in more depth. It is important, and Julian Franks, if he was here, would have said it about 5 times, and Tim Jenkinson. It is, public markets are important, but we mustn't forget about private markets. And of course, they're more difficult to study because the information is by definition more private. There's less disclosure. So we academics have a harder time studying them, but that doesn't mean that they're not important. And we do have some evidence, and that certainly needs to be discussed. And I've written down for ECGI and for USANET that, that this is something that we need to spend a bit more time on and devote more time on, but maybe that's one of the lessons for next time. So with this, I turn over back to you, Annette, for the final word, because I like the title of Vickers' paper, Who is the Boss? In case you haven't realized, the boss at ECGI, or certainly today, the boss at ECGI is Elaine, and the boss of today is Annette. So I'm turning over to the boss and the boss. Thank you.
Okay, thank you, Marco, very much for this concluding, like kind of summarizing the whole like morning and evening session. So there was an idea that before we leave, that all the speakers that put on the videos and we make a photo, like a group photo. So Ivars, can you come here? So let's do that.
Don't forget to socially distance, Annette.
Yeah, yes. So I'll take it on this camera. Yeah, so you stand there and I will be here. So we are distancing, right? So does that work?
I think you want to know who's still not asleep. So there you go.
Yes. Okay, perfect. So is that the group photo? Yes, anybody else? I was thinking so.
Oh, videos are coming on. You just have to bring out the camera and then,
I'll take the screenshot.
See, it takes a minute to brush the hair.
Yeah. Okay, so I have a screenshot here. Okay, perfect. Okay. Yeah, so thank you really everybody, and so for this, I think it was an interesting trial, at least for me. It was a good experience, and I think, unfortunately, we'll have to use this format in one or the other way. So we also took this as an opportunity to test. Like from my perspective, I think it went pretty well. Really. It's highly appreciated, all the speakers and discussants that stayed throughout the whole conference. I know in this format it's more difficult to stay focused, and there were at times like up to I think 70 participants, 80 that joined today, and I'm sure there will be many more from the ones that registered that are interested to see the video and some material after the event. So thank you everybody, and also the greetings from our rector, who is heading towards like midsummer celebration. The connections were still bad, but he says that the best sends best regards, and thanks to everybody for participating. So thank you, Marco.
Thank you, Ines. Thank you very much.
Thank you, Annette. And remember the Quakers, you know, chocolate, drink chocolate instead of alcohol.
Right. Okay.
Thank you, everybody. Thank you.
Bye. Bye.
Thanks.